welcome to the Self-Storage Made Simple podcast. I am your host, Thaddeus Campbell. This week, I've just gotten back from the Fall Conference in Las Vegas for the Self-Storage Association, the big SSA conference at the MGM Grand. And I wanted to come on and share my takeaways from the SSA conference and also where I think the self-storage industry stands right now based on the many conversations I had in Vegas. And for those of you guys who are not lucky enough to go out there, you can get a little bit of my take on what happened on the show. I also highly encourage any of you folks who were at the show, whether you're seeing this on LinkedIn, on YouTube, or you're listening to it on Apple or Spotify, please reach out and connect and leave comments, whatever it is you might be able to do, because I want to get your thoughts, especially if you took something drastically different away from what it is that I took out of the show. So first thing I want to talk about when it comes to the SSA show is the definite change in energy that I noticed in Las Vegas this time versus the last few shows that I've been at, which goes through the big ISS show, although in April at ISS out in Vegas, a little different audience. SSA tends to be more of the institutional level owners, the people with more of a longer track record in the space. ISS tends to draw a crowd of more people that are a little newer, maybe the smaller mom and pop type operators. And that tends to be the crowd that's there. ISS in April, not as energetic as we saw in September, but definitely was trending upwards. I was in National Harbor outside of Washington, D.C. in March for the SSA Spring Conference, and nowhere near the energy level that I saw out in Las Vegas, and especially going back to 2023 and the trade shows then. Just a definite increase in the overall positivity. So let's talk about now. I'll offset that by saying this business is incredible. It's such an amazing group of people in this asset class. And I'm going to give you a little bit of why I now think that is based on my conversations with people who've been here forever. So even talking about the last few SSA shows and the definite change in energy, I would say that that's a relative thing because the energy was still great. It wasn't like people were all doom and gloom. You could just definitely sense the pullback that's happened in the self-storage industry since the rate increases and sort of the end of the COVID boom in, April 2022 is when the Fed started raising rates. And really the end of 2022, early 2023, when the industry started feeling the effects of the slowdown in rentals based at, coming after that crazy increase that we saw during COVID. And you started to see something that really is a first in self-storage, which is the depression of rates, especially customer-facing rates, whether that be web rates or street rates that are advertised online. So I wanted to just say relative, right? Still every conference and trade show you go to, there's an air of positivity in this industry and people work together, but definitely an increase at the MGM Grand. There is a long hallway you got to walk through to get from the casino and the hotels over to where the convention center is. There's actually a restaurant and store shops row, and then another long hallway going down by the pool. I mean, it's like a quarter mile, half mile walk to get to the convention center. So you would pass a bunch of people and you could just see the pep in the step. You could see the excitement. You see people with smiles on their faces. A lot of people walking in tandem with other people not associated with them, having conversations about, furthering their business. And so I don't want to paint it like somehow previously was horrible. It wasn't, but this time definitely feeling what seems like a turn to starting kind of rising the tide again. So that's been a very cool thing to see. So why do we think that self-storage has that, that closeness, that friendliness, that those, competitors that are friends? I had this conversation with Mike Burnham on the podcast earlier this year, and he's like, hey, we got bought out. We literally got a hostile takeover. His father's company, he was there in the early 1990s into the late 90s. They went public in early 1990s. and got a hostile takeover from Public Storage in like 96, 97, and he's friends with those guys now. And why is that? Well, the theory that I've been told and makes perfect sense by many, many people is that in the early days of the self-storage industry, the you needed to work together because no one really knew what they had. And I've heard this story from so many different people. Mitch Feldman, Tony Artizzoni, was talking to Anna Saradziardina, who works for Talinvest, that's been in the industry for 40 years. Tony Artizzoni, who I mentioned, his father started designing storage in the 1970s. Barry Sherman, who's been involved in the industry since the late 80s, early 90s. They had to work together because in order to get a project through a planning and zoning commission, to get bank financing on a project, to get investors into a project, they literally had to share information. They had to come together and share everything each person knew, because if they didn't share that information, they didn't have enough data to go do all the different things that you need to do to get a project out of the ground. And that, fortunately, even into 2024, as this industry is now coming to its full maturity, it still exists. There's still that, we haven't gotten to that place where it's cutthroat. And as I talk to people from other industries, whether it be, retail, commercial, or office, or multifamily, it definitely doesn't have the same feel. So I want to take a second and just express how grateful I am to be in this very, very special industry that is self-storage. So now I want to kind of get more deeply into my takeaways from what I got out of being at the show, and what I kind of feel like is the overriding, presence of what's going on in the industry. And so the first thing I would say is that, of course, my specialty is in ground up development. That's how I came up in the industry. That's kind of what I've been more intimately involved with from the time I started, much more so than the value add or the long-term buy and hold cash flow type projects. So that's kind of where I'm most plugged in, I would say. And what I'm hearing from a lot of people is that debt and equity are starting to move a little bit again. It has been a very big challenge for the last couple of years to go out and find debt and equity, right? So debt being your, how you're going to finance the bulk of the project, whether it's through a bank, life insurance money. If you're going to get a big equity partner that's going to trade you that construction debt in exchange for some equity in the project, those have been very challenging to find for the last couple of years, except for all but for some of the very most experienced investors that are like the go-tos for people that did have the money to be able to do that. And there are a couple of reasons that happened. One of them was, of course, interest rates went up, right? And banks were very nervous to give construction loans because the closure of SVP and Signature Bank, right? Silicon Valley and Signature Bank were closed in, I can't remember if it was late 2022, early 2023. And the Fed started to get a little more critical in their stress testing of the banks. It's the classic reaction when something bad happens. We tend to overreact. And so banks got far more stringent in their lending practices. And what happened was you had a group of developers who would put multiple projects in their pipeline under the idea that they were going to be underwritten a certain way and that the bank was going to allow them to go out and get debt based on their net worth and their total tangible assets, the amount of free cash they had. And then those parameters changed drastically. Interest rates also went up, which made far fewer projects pencil to the bank, right? If your interest rate goes up, the total cost of debt you're going to have on the project goes up. What we call DSCR, debt service coverage ratio, becomes harder to achieve. And what debt service coverage ratio means is your income from your project, the bank requires that it be a certain multiple above what the debt on your lending is going to be, right? So if I borrow $1 million, let's say this, if I take a mortgage or a loan that costs me $1 million a year to service that loan, The bank is going to want me to have income of $1,250,000 a year, 1.25 times what my debt service is going to cost. So if I don't have $1,250,000 in income projected on the project, I can't get a construction loan that's going to cost me $1 million a year to service that loan. Now, here's the problem. If I'm borrowing money at 5% on a construction loan, that $1 million gets me way more money than if I'm borrowing money at 9.5%. All of a sudden, what that $1 million covers becomes a way less, a smaller project. I can't borrow the same amount of money. So from 2022 to 2023, when a bunch of these projects that were underwritten in 2021 and 2022 with 5.5%, even if you were being conservative, you might have underwritten at 6.5% construction debt. All of a sudden, the bank is lending at, even for experienced lenders on construction debt, 7.5%, 8%, 9% interest. What you could go borrow from the bank shrank considerably. And we saw projects that were underwritten at a 75 or 80% loan to cost construction loan. In other words, if it was a $10 million project, they were banking on getting $7.5 to $8 million of that $10 million from the bank. Now, all of a sudden, they might only be able to get $5 or $6 million from the bank, which flips us to the other side of this coin, which is equity. How do I go raise that other $2 million to $4 or $5 million on that $10 million project? I go find private investors and I give them a stake of equity in the project. A lot of times that'll be through a syndication, through a limited partnership, and you'll decide how much does each share cost and what does that get somebody in terms of shares in the project. And you'll go raise money. Well, at the same time that it became harder to get debt, what a lot of people that are private investors were seeing is a T-bill, a super high security investment, going and buying a treasury bond. Instead of paying out 1% like it was in 2020, 21, if you were lucky, it was now paying 5% interest. So you could park your money in a T-bill for 5 years and get a 5% return. Now, if historically inflation is at 3 or 4% and you can invest in a treasury bond that gives you 5% return, you're like, man, that's a 100% government-backed investment that is as safe as I can get, and it's giving me a 5% return. Or do I go invest in a ground-up commercial real estate development project where, yeah, I have the promise of maybe getting a 15, 20, 25% return, but far more risk? Which one do I take? So now as a developer, I needed more equity because the bank's not covering as much. And at the same time, the people with that money are, I've actually had this conversation with a couple people this week where they're just not interested in investing right now. Even now, with things starting to turn, they're just a little nervous, and they have that ability to go sink their money into a T-bill at 5%. I don't know what it is now. I think it's gone down a little bit the last few weeks. So maybe not 5% now, but you did for a bulk of the last year, year and a half, have that outlet. So as developers, that's what we were competing against. And what we've seen for the last year, year and a half is a bunch of these projects have sat on the sideline. I've seen them because they get put in front of me all the time. Hey, are you interested in this deal? Because the developer that owns the project can't get the debt and equity to get the project out of the ground. So we're starting to see, and I heard during the SSA show, 2 different deals. One of them got construction debt in the low 6s. One of them got construction debt in the high 5s, with both of them the lowest with 24 months interest only. I think one of those 2 deals actually had 36 months of interest only, which is another thing that we saw shrink post April 2022. We saw the interest only period that banks would offer on construction shrink. It would go from 36 months. In some cases, I saw people only getting 18 months of interest only. Now, for self-storage, let me explain to you why that's so important. For those of you who don't understand, it's going to take me 12 to 14 months to get this thing built. And then it's going to take me another 36 months to get it leased up at a minimum. I actually know people right now that are underwriting to 42 or 48 months of lease up, 4 years to get this site to the point where economically it is fully occupied. Now, at some point during that lease up, you're going to reach a point where you start to become cash flow positive. During COVID in 2020, 2021 into 2022, a lot of new facilities were leasing up. I heard stories as low as 8 months where they were getting to full economic occupancy. That's not the case anymore. So I'm not going to be cash flowing positively in a lot of cases until month 24, 26, 28, right? So I've got 24 months of from the day I open, plus another 12 to 14 months during my construction period. I'm every bit of 3 years to get cash flow positive where I can afford to not only be paying the interest on my construction loan, but also the principal. So if the bank comes to me and they say, hey, I'm only giving you 18 or 24 months of interest only on this construction project, I know that I'm going to have to keep a substantial amount of reserve money for when that principal payment kicks in, because that's going to change my payment a lot. Now, how do I get that extra? I go and get more equity, right? I've got to sell more shares of the project. But we already talked about that. Equity's been super tight. So what I see happening right now, equity is not opening up as quickly as debt is, but debt is starting to open up. The Fed meets next Wednesday as I'm taping this. Actually, as this airs live, the Fed will have already made their decision. Most people I talk to expect a quarter point, 25 bips of a drop. But we've already started to see that reflected in the lending market. So I don't know how big of a difference that's going to make in actually what's going on with lending rates, because we've already seen, I saw something yesterday where the average home mortgage last week, a 30-year mortgage, was trading in the low sixes. That was in the sevens not that long ago. This year it was well into the sevens. So we've already seen, without the Fed dropping interest rates at all, we've seen the lending rates start to come down, I think reflective of what banks think is going to happen, which is a drop. Wouldn't surprise me to see a 50 bip drop in the Fed rate to go down 50 points instead of 25, or half of a point, I guess I should say, rather than a quarter of a point. So that will be a stimulus, but I think we're already seeing it as far as what's going on with debt. The question that I'm interested to see is, do we start to then see an increase in equity coming into these projects? Because what's going to happen as you start to see a drop in your interest rates and you start to see an increase in the total amount of the project that you can get covered with debt, whether it's from a bank or a life insurance company or from some type of private equity, you're going to see an increase in the return that an investor can see for that other portion of the project that a developer needs to go raise private equity for. Let me be very clear here. I'm saying equity on the debt side because there are big Wall Street level equity groups, people with a ton of money that take the debt position. They'll typically trade a little bit of equity in the project, but they'll be a general partner in the project. They'll be on the GP side, the ownership side of the project, as opposed to when I talk about equity on the LP side, the limited partner side, the side that is not responsible for the construction debt so much as they're filling in the gap that the construction debt won't take. So that gets a little confusing because you have big equity groups that might be on the debt side. I want to be very clear there, as opposed to how you typically fill the LP side of it, which is typically more of your single investor, right? You'll sell 30 shares in the project to 30 different individual accredited, in a lot of cases, investors, people that have a high net worth. I think the accredited investor rules right now, you have to have averaged $250,000 a year in income for the last 2 years, or if you're married, I think it's 300,000 you have to have averaged, or you have to have $1 million in assets beyond your primary residence. So that's the standards that you have to meet to be an accredited investor. Those are typically the people that will fill what I call the equity side of the deal. Sometimes you'll be able to raise, there's different ways you can set up a syndication, and there are ways you can use friends and family money, people that you have a close relationship with that are not necessarily accredited investors. For me, as a developer, the last thing I want, if I'm going out and I'm raising $2-3 million on a project and I've got to get $100,000 at a time, because there's a limit to how many people you want in your project, because you just don't want to deal with 150 different investors, right? Because you're going to have to be updating these people. You're going to be fielding phone calls. The last thing I want is your last 100 grand. That's the last thing I want. I want you to be making that investment with a portion of your money that you have earmarked for a little bit more high risk, high return investments, right? So maybe 20 to 30% of your total money that you invest will go into a project like I'm going to do. And I don't want the whole 20 or 30%, right? If that 100,000 represents the whole 30% of your high risk, high return investments, I would much rather you spread that out over multiple investments to lower your risk, right? It goes back to playing poker and management of your stack, right? How much money do you have? How much are you going to play in one game? You're not going to take your whole stack into one game. It's just not because you're going to have variance. You're going to have times where things don't go right, especially when you go into those high risk, high return investments. Now, what do we love about storage? Over time, the number of projects that have gone south is very, very minimal. Literally, it's like 2% of storage projects historically that haven't shown a return. And the average returns over the course of the last 50 years in storage have been hard to fathom. A lot of, until like 5-6 years ago, I talk to Barry Sherman about this all the time, one of my closest friends. If you don't know Barry, find him on LinkedIn, S3 Partners. Super guy to have a conversation with about the industry. He's been involved in it for years and on the SSA, and especially at the state level, a bunch of different state boards. And the returns were like in the 40s for IRR, your internal rate of return. In other words, the percentage of your investment that you would get back as a yearly return were in the 40% for a very long time. Is it as easy to find that today as it was in 2000, 2010? No, it's getting more challenging to find those sort of returns. But man, if you're in the 20s for an IRR, that's a fantastic. Imagine if you put $100,000 into something and 5 years later you got over 200,000 back. That's a fantastic return. You double your money in 5 years. So still a fantastic asset class to be in. But it's definitely, as it's gotten more mature and kind of the cat's been let out of the bag, it's getting harder to find those home run deals the way we were. So that's debt and equity. Wanted to talk about that a little bit. The other thing that is the big issue that's going on in storage right now is the access to rate information. And I'm going to explain what that means. As developers, what we do is we go into a market and we look at that market and we analyze what the existing facilities are doing in order to guesstimate what it's going to look like when we open our facility. And especially in markets with a big presence from the REITs, Public Storage, CubeSmart, Extra Space, NSA REIT, who is a conglomeration. They have a bunch of different trade names they operate under, and U-Haul. We know that they've employed this idea of ECRIs, existing customer rate increases. And what they're doing is the customer facing rate that they're advertising, both what they call their web rate, in other words, the discount you're going to get for signing up online, and the in-store rate that they use to offset that discount, are very hard to put any trust in for the last year and a half, 2 years, because they're coming up with a web rate number that they know is going to entice somebody to come and sign up. Sometimes it might be $0 for 2 to 3 months. Might be a 50% off. And what they'll do is they'll come up with a number that they know is going to draw attention. And they have an algorithm and they track data. So they know what number is going to spike the number of people we have coming to our store to rent a unit. And then they'll use the in-store rate simply based on what percentage discount they want to give. So if they know $90 is the number that's going to spike interest and they want to offer a 50% discount that month, they'll make the in-store rate $180. Not because that's reflective of what an existing customer might actually be paying. Now, 4, 5, 6 years ago, that in-store rate in most instances would be reflective of what their achieved rate in the store actually was. Now, as developers, this is making it very hard for us because we don't have a way to go and find out what that information is to know if we want to build a new store in a given market. Now, what started to happen over the last few months is, especially for some of my friends who are very experienced developers who have a relationship with the REITs, because the REITs will manage their properties for them when they open. Right. And the REITs want that. They want to have new stores to manage because that's how they increase their overall income. That's how they get their stock price to keep rising. It's also how they have a pipeline of new stores for themselves to buy, right? Is those relationships with developers and managing those stores. So what we've started to see is that the REITs, in the instances of stores that they own in-house, and not all the REITs, but a couple of them, are getting much more willing to share more achieved data from stores they own. They will not share data from stores they manage for other people, and that makes perfect sense. But they'll share data from stores they own with developers because they understand if they don't do that, there's no way for us to build. It becomes very, very challenging for anyone to want to take the risk of ground up construction. And the simple reality is the REITs need new construction because they've got to grow their share price. If they don't grow their share price goes through the floor, they go out of business or they get taken over by one of the other REITs, which is absolutely what they don't want. So we've started to see more of an exchange of information and the ability to go into a market and really start to understand if the demand is there based on the current achieved rates in the market on whether or not you're going to be able to have a successful new project in that market. So what does this all mean? Well, we haven't really seen a dip in construction the last couple of years. I expected we were going to have a decline in the total number of new facilities, and it's actually the opposite. More facilities came online in 2023 than in 2020, 21, and 22. Of course, COVID had a lot to do with why there were so few coming online. I think the drop was like 300 facilities, about 25% from 2019 versus the 2020, 21, 22 numbers, which were all very similar in the 800s. So you had like 1,100 facilities plus in 17, 18, 19, and then it dropped during COVID pretty substantially. I thought it was going to drop even more, but there were over 1,000 facilities that came online in 2023, and it looks like 2024 is going to be very similar. So those are my two big takeaways. Debt starting to open up a little bit, data exchange starting to open up a little bit. What does this mean? I think we're going to see some better projects coming online. There's still a lot of projects out there that were underwritten during COVID that do not pencil very well right now. And I think some of those are going to face a long-term challenge. Somebody might have to sit on it for a while if it ever turns into something that's going to work. However, for those projects that looked pretty good and looked amazing during COVID, but they've been sitting on the sideline, I think you're going to start to see some movement there. As always, self-storage is a unique industry, man. It's been the number one asset class for more than 40 years in the United States now. I don't see that changing anytime soon. So for us at Safe Storage USA, still absolutely a asset class that we're going to stay involved in. It's getting much harder as those big Wall Street equity groups, the big private money groups have started to really shine a light. It's getting more and more challenging. So I'll come back. I have a lot more thoughts. The half hour went by fast. So I do want to share one thing that I think is important for you guys to understand. I'll go a couple minutes here, which is how many deals over the last year and a half, 2 years are being bought at negative leverage. And what does that mean? That means that the average annual return of that facility is less than what it's going to cost you to secure debt. So if my debt is at 7.5% and I'm buying that facility at a cap rate of 7%, in other words, I'm buying the facility in a way that I'm only returning 7% of my capital every year, but my debt is costing me 7.5%. I'm losing money every year because the cost of my debt is more than the return I'm getting on the investment for my total purchase. The vast majority of facilities that are being traded right now are being traded at negative leverage. And why they're being traded at negative leverage is because the buyers are banking on an increase in the future value. Think about that for a second. There's a word for that. It's called gambling, right? Anytime you bank on increase in future value, you're taking a massive risk. We at Safe Storage USA have made a very deliberate choice that we are not going to buy anything at negative leverage unless there is a 100% clear path to getting it to positive leverage, such as we buy a facility and we know that they're at 50% of the market rates. Everything had been going up for so long, everyone's like, it's always going to go up. Well, we know the history of that. So I want to let you guys know a lot of things being bought at negative leverage. One of the reasons they're being bought at negative leverage is because a lot of the big equity groups have so much money coming to them from people who want to get into storage. They're almost forced to invest. They're almost forced to buy things. Because if you collect a bunch of money and you say, hey, invest with me, I'm going to go put it in self-storage, and everyone's coming to you and saying, yeah, I'll invest, yeah, I'll invest, yeah, I'll invest. How do you not put that money to work? Otherwise, you're promising that person a return that you're not giving them. So we've been the opposite. And a lot of you guys, if you've been investing with Safe Storage USA in the past, we haven't touched base with you for a while. Get ready, though, because we got some stuff coming down the pike that we know. We've been very deliberate, as we said. We're being very selective about what we're going to invest in. But we're getting to a point now, as you know, when it rains, it pours. We've gone through a little bit of a drought. It's been a couple years since we bought anything, but the market is starting to shift and we're seeing some opportunities that we're very excited about. So I'm going to wrap up now. I'm Thaddeus Campbell. Thank you so much, as always, for tuning in to the Self-Storage Made Simple podcast. I want to thank my friends, Jean-Michael Dier at PropRise and his team, Matthew Krager and Khalid El Amadan. I'm very excited for the partnership we have with them. They are the sponsors of the Self-Storage Made Simple podcast. If you have not checked out PropRise, go to their website, www.proprise.io. Schedule a demo with them. They are supercharging your search for self-storage properties and raw land. So thank you guys, as always, for the support of the Self-Storage Made Simple podcast. We'll be back next week with an actual guest. You won't have to listen to me for 35 minutes in a row, but want to thank you, as always, for tuning in. Tip of the day, listen to this at 2x speed. If you're not able to comprehend everything at 2x speed, go to 1.2 or 1.5, work your way up slowly. You'll be able to listen to a lot more podcasts, a lot more books on tape, retain a lot more information. Thank you guys for listening. We'll be back next week.